Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, the U.S. dollar has had a tremendous amount of activity over the past few weeks. If you take a look at any chart, you'll see that up until July, the dollar was on a one-way downtrend. And this one-way downtrend was a story of the entire market, which is that the weakness of the U.S. dollar not only caused oil prices to skyrocket, but it was a headache for everyone because it boosted inflationary pressures, it caused oil prices to skyrocket, it boosted the value of the currencies for other countries around the world, such as Europe, Eurozone, the UK, and so forth, and that took a toll on those regions' economy because the Eurozone, for example, or Germany, is very, very export dependent. Whenever they have a strong currency, it weighs on their exports because when goods are expensive, people look for alternative places to import from. So the weakness of the dollar created a headache for everyone. But it was the weakness of the dollar that, and I will argue this, that basically prevented the U.S. economy from slowing down further than it has already. Because the dollar itself the weakness of the dollar has pros and cons. Obviously, the disadvantage is things like, lower purchasing power here in the U.S., high inflation, and so forth. But the big beneficiary is that it attracts foreign investment. What it does is it bolstered or supported the U.S. housing market by bringing in a lot of foreign investors. It attracted a lot of demand from sovereign wealth funds looking for bargains. If you recall, in June and July, there was a lot of sovereign wealth funds investments into banks, into actual companies, because U.S. companies were cheap. So there's definitely pros and cons to the U.S. dollar. But the U.S. dollar hit a record low in the month of July, and since then it has skyrocketed. We have not seen this type of move in the currency market in years. In a little less than 2 months, the U.S. dollar has rallied more than 10% against the euro. I think about 13 or 14% against the British pound. I know for sure it's about 3,500 pips. And, leaps and bounds further in terms of its appreciation against the Australian dollar, New Zealand dollar, and basically everything in sight. This chart here illustrates the degree of the move in the euro dollar over the past 2 months. This is a weekly chart of the euro dollar. The euro dollar basically dropped 1,700 pips or 10.5% in a little less than 2 months. This is the move in the pound dollar where it basically fell 16% or 3,500 pips. This is the move in euro yen, showing you that this type of depreciation in the euro dollar and dollar yen is not just unique to the majors. We're also seeing a sharp sell-off in carry trades such as euro yen. We also see a similar move in pound yen and dollar yen. Obviously dollar yen to a smaller degree. So taking a look at these type of performances, a lot of people may ask, what in the world happened to cause this sort of major top in the various currency pairs, as well as the sharp rally in the U.S. dollar? Well, it's a lot of things, and I'll touch on them, more specifically in detail. But just to give you a bird's eye view of what's been changing is that right now, even though we don't necessarily have the sort of tensions that we did when Bear Stearns collapsed, what did happen was that we had a huge drop in oil prices. And this huge drop in oil prices from a high of, I think, $147 a barrel, which is a peak in July, all the way down to today, where NYMEX is closing at $102 a barrel. This has translated into a broad-based dollar rally. And right now you should be looking at the dollar-yen chart. And this dollar-yen chart shows you that we've only seen a small movement in dollar-yen compared to the movements we've seen in euro-yen and pound-yen. And this small movement tells you that the sell-off in euro-yen and the sell-off in pound-yen is not a function of a sell-off, a rally in the yen itself. It's just a function of the fact that the dollar has strengthened so much against the euro and against the British pound that that pair is pulling those currencies lower. Because whenever we trade euro-yen or pound-yen, for example, those are considered crosses. And in euro-yen, basically what you have is you're trading the euro-dollar and dollar-yen in order to create the euro-yen cross. And usually when, let's say, euro-yen falls, it's either because the euro-dollar is falling or dollar-yen is falling or both is falling. But because we took a look at this dollar-yen chart, you can see dollar-yen fell, but really not too much. It tells you that the move in euro-yen and pound-yen is almost completely due to the moves in the euro-dollar and pound-dollar. Now you take one step back and you look, what is causing the move in the euro-dollar and pound-dollar? That is just the U.S. dollar. So the one thing moving in the currency markets these days is just the U.S. dollar. So here shows you, this table that I put together shows you the relative performance of the U.S. dollar year to date. And you can see that the low yielders, being the Japanese yen and the Swiss franc, have performed the best, whereas everything else has performed terribly against the U.S. dollar. So the only currency pairs doing well right now are the low yielders, and they will probably be the only currency pairs to continue doing well going forward. We also see, a broad-based sell-off in carry trades. This is the performance of various currency pairs year to date against the Japanese yen, which you see here, and the dates illustrated here. And once again, we're seeing a sharp fall in carry trades, the Japanese yen crosses. But if you go back and take a look at this chart, you can see that it's primarily due to the drop in the major as opposed to the move in dollar-yen. Here we have a chart of volatilities. And part of the reasons why carry trades have performed so horribly is because volatility is skyrocketing. Carry trades do well in an environment where we have three factors going for them. One is low volatility, strong risk appetite, number 2, and global tightening is number 3. So you can see from this table here that volatilities have skyrocketed. We see this as traders on a day-to-day basis. When earlier this week, euro-yen had a 500-point intraday move. We've become, in the past, euro-yen moves, 100 pips, maybe 200 pips on a good day, but earlier this week, we had euro-yen basically plunged from 157.75 all the way down to 151.40 in a matter of hours. And that is what has caused this sharp rise that you see here in volatility.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.